Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, May 1, 2017. Looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And basically, what we had at the end of the day today was a sideways day on extremely light volume in the market. As you can see here, the volume is just over 50 million shares down at the bottom. You can see where this is significantly below the average 90-day volume that's represented by the black line running through the volume chart. And what this tells you is that the market is on pause mainly for a couple of reasons. So this happens all the time when the Federal Reserve is going to meet. And this week, the Federal Reserve is meeting Tuesday and Wednesday. And after Wednesday's meeting, they come out with their FOMC announcement or interest rate announcement or decision. And I don't think anybody's expecting them to raise rates this month. However, each and every time that we come into a Federal Reserve meeting, for whatever reason, the market quiets down and it seems to be waiting on the Fed announcement with bated breath. Whether that's happening this time or not, what we saw today was a volume, a market that was up on extremely light volume a little bit. It was up 4 points in the S&P, 0.25% in the Spider. The Dow was actually down 27 points, but we're not going to read anything into that. The NASDAQ was the strong horse, up 44 points or 0.75%. And the IWM, which we'll get to in a minute, was also up more than 0.5%. So that was a good showing. What I find interesting, and really the only thing that we can take away from today's market, because a flat market or slightly higher with light volume, there's nothing we can really take away from today's market and learn anything from. So we're not going to belabor the point, but what we can do is take a look at the daily chart and see that we have 1, 2, 3, 4, 5. This was the fifth day of sideways activity above the 237.61 important number. Now, we never have yet come down to test that number. That's still a possibility. Maybe we do it tomorrow. Maybe we do it Wednesday in and around the Fed announcement, which markets have a tendency to certainly become disjointed around those announcements. So maybe we come down and test it then, or maybe we don't. Either way, we're consolidating above that level. And that's really just telling us one simple thing. The market is consolidating to go higher until proven otherwise. That's the way you have to read the chart. We're not guessing. We're not saying it's probably going to do this. We're saying the chart is telling us that we're consolidating above the 237.61 level to go higher. And it's irony. Well, it's not really irony. It just seems like irony that on Wednesday will become the seventh day of this consolidation phase. I think we'll just take that for what it's worth, but I find that interesting nonetheless. When you look over at the IWM, we had that big down day on Friday, and that is a little bit of a head scratcher. When you look at that, we came in and we filled a gap from, what was the 24th of April. But what was interesting was it was a pretty big, healthy down day, and that's generally a sign of lower prices to come in any market, any stock, any commodity, whatever you're looking at. That's generally what the chart is telling us. We'll see if that's the case or not. That would generally mean lower prices for other markets as well. However, today we did have a slight recovery, up a little more than 0.5%. But was also interesting, and I forgot to mention this on Friday. I got caught up in the monthly chart, and one thing that I forgot to mention when we did talk about the monthly chart was the fact that on the last day of the month, the IWM dipped down to close below this trend line. I think that's interesting, if not important information. No two ways about it in my book. I don't think it's a coincidence that the market dropped down to finish comfortably below that trend line on the last day of the month. And that was the day we had the big down day. So I'm either going to look at it as That was really the reason why we dipped down, to make sure that they closed below that line. And that's not necessarily a negative thing long term. It just happened. And we'll just look at it like that. And we could certainly trade higher from this point forward, or it was a sign of lower prices to come. And we'll know that soon enough. If the IWM does begin to trade lower with or without the remainder of the market, we're going to have to assume that the larger market indices will follow suit. So I'm watching the IWM very, very closely. Might as well take a look at the VIX today, because the VIX is making a bearish pattern and continues to melt lower down around the $10 level. Now that's interesting in and of itself, because the VIX doesn't get down to this level all too often. So on one hand, you have to be a little on guard that the market could drop and the VIX could spike from down here at $10 or slightly below if it should dip below $10. Or maybe this is the time where it gets down deeper into the sub $10 area and reaches down towards $9.50 or so, $9. We'll see. There's really no way to tell right now. But what I can tell you is there is a $9.39 area on the VIX that, and if it should get down in that neighborhood, 940 in that zone, I think that would be an area you should get a bounce higher in the VIX. When we look over at the NASDAQ market tonight, first we want to look at the transports. Pardon me. Showing more weakness today in the transports, closing below the 20-period moving average. I'm going to have to look at this as a sign of weakness. So the fact that the market is having a difficult time rallying, the IWM had a big down day on Friday, did rally a little bit today. We had a chance to rally earlier in the spider and backed off a little bit, closing up for the day, but really more so flat than anything else. The IWM giving us a little bit of trouble on Friday, and the transports closing below the 20-period moving average today is a little bit concerning for the upside conversation, for the bull case. So we're going to, again, watch this closely, and I think a lot's going to hinge on and be dependent upon what happens on Wednesday. Unfortunately, we tend to hang our hat on much of what the Federal Reserve says, what Janet Yellen says, what the Fed is projecting in terms of their forecast, notwithstanding the fact that their forecasts are wrong 90% of the time. But we tend to hang on every word they say, and we want to believe that they know what they're doing. So what happens is the market ends up quieting down and waiting for the Fed to tell us what to do, which is really not the case, but you can't help but be one of the participants waiting for the Fed, because you can't trade the market if it's not trading ahead of the Fed. And right now, it was very quiet today. We're trying to look for clues to tell us what direction the larger move is going to be. And right now, we have the IWM telling us potentially an ominous thing based on Friday's move. The transports also telling us potentially this index wants to go lower, and if it's going to be a leading indicator, then the others will follow. So we have to watch closely, but also on guard that everything could change on Wednesday in an instant. What's the NASDAQ telling us is, what can you say? It's just powering forward, making new highs almost each and every day. There is no price target. It just continues to go higher. Again, this is one of the reasons why I don't love this index for a leading indicator, because it is top heavy. Why is it going up? Well, look what happens. Amazon up $23 today. What did Google do? I don't even know. It's not even on my screen in front of me. Google up $8 today. Apple, I know, was up. Apple was up big today, up $3. Apple was up $3 and change. So when you have situations like this, where the top-heavy index is being led higher by the big behemoth, big tech names, that's what happens. And, the other indexes just aren't necessarily following suit today. But when the institutional traders or the big institutional investors are still buying into the big tech names, You have to believe that they're buying into the market going higher. They're just not buying 3 or 4 names. They're buying into the story that the market does go higher. So we'll see what happens, but a lot riding, at least in the short term and from a short-term perspective, on the Fed on Wednesday. Gold took a hit today, and look where it went. So the low today was 1254.90. My number from before that we had on the chart from months ago was 1254.70. Pardon me, by the way, this line wasn't on the chart for months. This line was from this pivot low here that we were looking for that number and a bounce off that number. Quite interesting what happened. I was actually looking for that last week. It didn't happen last week. It happened today. But you can see what happened as soon as we hit that number, 1254.90. We were looking for anything in and around that area. You see where we are now, almost at 1258. You are bound to get a bounce off this area. Whether it's going to be a more sustainable bounce or not remains to be seen. But this area should be supportive of the market. At worst case, the 50 period moving average down here at 1251. And you can see here down on a 10-minute chart, as soon as we got down into that area, here's where we made the low of 1254.90. That's where we got the bounce. We got a retrace, a higher low, and then a bounce. And remember, all charts look the same, whether this is a 60-minute, a daily. You get a bounce off a level. You typically get a retrace. This was a deep retrace, and then you get the rally after that. And so now this is making what looks to be a bullish pattern and probably will trade up higher, at least into the 50-period moving average up here at 1261, give or take. And that's just how markets trade, but that's on a short-term basis. But back to the daily chart, we were looking for this level. You can see why. All the chart consolidation, this low from the breakout area, markets like to come back and check in with former breakout areas. That's exactly what happened in the gold market. A lot of support in this zone down here. Silver. Now, silver's in an interesting position. Right now, as I make this video, silver is at 1654.6. The low here is 16,893. That's the low. What did I just say? Current price? Oh, 1690. I don't know what I was just looking at. So again, 1690. This is the low here. Let me do it again. 16,893. Okay, and we're at 16,905. Those are the numbers. If we close below this level, okay, then it opens the door for lower prices in silver. If this level holds, then we'll probably get a multi-day bounce out of this area. That's just the way it works. It's very, very close right now. All right, nothing else to say about silver. That's the story. If that double bottom area holds, probably get a bounce. If it doesn't, lower prices coming, at least down to 16.5, just from a bird's eye perspective. Looking at the crude oil market, crude sold off again today, and we're melting down. This is a bearish pattern, and it looks like it wants to go lower. The longer we consolidate and melt away down in this zone, the less likely we are to have 48 hold again. In fact, it probably, at this stage, won't hold right now. And what we're really looking for is a pierce of $46 a barrel in crude oil. That's this low from back here. That's a buy zone for the energy complex. Anything before that is really no man's land. Right now, there's no trade. We're looking for lower prices. If we see some kind of a spike higher and we can play a retrace pattern for a bullish pattern, that's different. That's not what we have here. Right now, we have a bearish pattern that says it wants lower prices, but you can't sell a market that's down this much. You can't sell a market in the hole like this. It's not a good risk-reward trade. We want to wait for the market to tell us which direction is likely going to be the high probability scenario. At this point in time, you just wait for it to fall, look for a reversal around 46, and that's where you hop on for a ride to the upside around the energy complex, whether it's in crude oil or some of the other energy stocks. For example, the big integrated oil plays, Conoco, Chevron, Exxon, some of the Valeros of the world, that kind of stuff. That's where you want to play when oil gets down at 46. Right now, we're in no man's land, nothing to do. The bond market was down slightly today also. Again, making a bearish pattern. Looks like it wants to trade down into the 50-period moving average. So now, the longer we stay away from these highs up at 155.20 or thereabouts in the 200-period moving average, the more probability is that we're probably going to trade lower before and if we go trade back higher. So right now, it looks to me like the bond market's making a sideways consolidation to trade lower into the 50-period moving average. But keep this in mind. The issue is that on Wednesday, whatever the Fed says, no matter what they say, the dollar, the bond market, the stock market, crude oil, gold, silver, it's all going to become, it's all going to start trading like an EKG chart, at least for, a period of time after that Federal Reserve announcement. So whatever the chart looks like leading up into the announcement doesn't always necessarily mean it's going to play out like that, because we get this disjointed behavior after the Fed announcement. It's like an earnings announcement. Sometimes the chart patterns play out perfectly, but sometimes, just like an earnings announcement, you get a failure of a pattern because you never know just how the market's going to react to a piece of information, specifically from an earnings report or the Federal Reserve or something like that. So we just need to be aware and not take the pattern that's developing now with such certainty as this has to play out to the 50-period moving average because it's a bearish pattern and that's the way it works. That's not necessarily the case with the Fed up and coming in less than 48 hours. And the bond market always has a tendency to move large, or most of the time, in and around the Fed announcements, as does the dollar. And you can see what's going on here with the dollar. We're just making a bearish consolidation pattern right on top of the 200-period moving average. And again, this looks like it's setting up to play out one way or the other, either downward after the Fed announcement or a failed pattern, and it goes up to the 20-period moving average after the Fed announcement. One or the two things of those two scenarios is likely to play out on Wednesday afternoon. And we know that our objective is for the dollar to get down to the lower portion of this trend channel around 97. That's what we're looking for. And with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.